All right. Well, the cell phone says 5:30. Other computers say different times, but we're going to go with AT&T on this one. And welcome everybody to our last content session for AngelNV's Founder Bootcamp. Most of you have made it the whole way through. Thank you for your comments about my beard, DP. And for those of you who've been through a few winters with me, know that this is a wintertime activity for me. Thanks again for coming out for our final night of FundNV. AngelNV. I'm gonna start us off with a few announcements, and then we'll turn it over to Judy, who will introduce our presenter tonight, Josh. So as a reminder, we have 5 programs that we work on here at Startup NV. We have an accelerator program and an incubator program. The accelerator concentrates on 10 scalable startups at one time. The incubator focuses on everybody. So you can jump into the incubator at any time at online.startupnv.org and go right through the process there. We have a third program, which is our FundNV, which funds the companies that are in the accelerator program after they've been in it for between 3 and 4 months to become eligible to get a $50,000 investment from FundNV, assuming they're staying on track and everything's current. So a term sheet usually goes out around the 100th day or so in the program. And then finally, this program that you're in, our AngelNV program, which the main focus of it was originally to create new angel investors in our community, because those of you who are with us in Nevada know that while there's a lot of wealth in our state, there's not a lot of angel investing going on here. So our aim is to find 40 accredited investors who want to be angels. I spend 11 weeks with them, teaching them how to do that well. And then at the end of that conference, they choose a company and invest $200,000 in it. So in order to give the angels in that group choices and options and things to invest in, and some companies in our community the opportunity to get that investment, we run this boot camp that you're a part of right now, teaching on the founder side, essentially, what do angels want? What do early stage investors want? So we've had a great set of speakers that have talked about every single topic that's relevant to get you ready for an angel investment. And in about 2 weeks, we'll be closing up our application process. It's still open. I'm going to comment on that in a few slides here. So again, thanks for coming and thanks for participating in our programs. The way that we think of how this works is that founders and startups sort of progress from the feasibility stage through the viability stage and into scalability. And usually somewhere between viability and scalability is where they become investable from an angel perspective or from a early stage investment perspective. So our VOIP program, our incubator program, sort of focuses in the feasibility stage. Our accelerator program focuses in the viability and scalability stage, where funding is more likely. And our job here in our bootcamp is to kind of move you down do everything we can to provide resources and advice and everything else to kind of move you down this timeline from ideation through beta to product launch and the revenue generation and scaling with some investments along the way. So some information about us. We've been around for about 3 years, and since we've been around, we've had about 450 companies pitch to get into the program. 48 of them have been admitted and have gone through it. There's currently 10 companies in the program, and of the companies that have come through, 18 of them have attracted investment in just under $70 million, which is awesome. Except that less than 1% of that money has come from investors in Nevada, which is one of the main reasons why we wanted to run the AngelNV program, so that we could create more early stage investors in Nevada to invest in our Nevada startups, so that when they hit it big, that not only do the founders make money and the employees at the companies make money, but the investors locally make money. And then a great cycle starts. Those people who made money think, hey, I've hit the lottery, it's time to retire. And you retire for about 90 days, buy some cool toys, whatever your hobbies are, and then get bored. And guess what the next thing people in that situation do? They either start another company and start the whole cycle over again, or become angel investors. So that's the cycle we want to encourage. And that's part of what our mission is for AngelNV. Our program, as I said, has an investor focus and an entrepreneurial focus. This part of the program started back in September, and it's ending in the next 2 weeks. Applications are getting filled out for the investors who start in January and make their investment in March. So tonight we're going to hear from Josh on deal terms and cap tables and preparing for due diligence and all of those deal-making things that everybody wants to get themselves involved with. So be prepared to be dazzled and learn stuff that you maybe haven't learned, or some things that you think you know that Josh is going to make sure you know. And for our application for the $200,000, you see a couple of links on the screen there. There's the really long one, which is in the chat. And if you just can't get your head wrapped around that really long one that goes to Gust, you can go to the angelnv.com page and go to apply, and then just click on the apply button. It'll take you to that crazy long Gust link there. So the application price is $49, but we're going to extend the early bird pricing through tomorrow to give everybody a chance to get things filled out. And the one thing I will say is the Gust application is kind of long. I mean, it's going to take you probably 15, 20 minutes to fill it out, maybe longer if you're not well prepared for it. So, and you don't get charged until the end. So if you want to take advantage of the early bird pricing, put some placeholders in that application. There's some things that are required. They won't let you go on unless you put something in the field. So put some placeholders in there, finish the application, pay the $29 to get the better price, and then go back, sign back in and fill in the information that you put placeholders for. And the whole Gust process is designed for you to kind of go back and keep updating it constantly, because you want to put your best foot forward at the time that the angels start to look at the applications. We have some angels in the program right now. So they're going to begin looking at the applications probably early next week, but they're really going to scrutinize it for, starting in early January. So even after you've put your application in, and maybe you have an update to to your pitch deck, or an update to a video that you've uploaded, you can go ahead and you're going to be wrenching on your Gust profile indefinitely, not just for our program, but there's a lot of other investors out there that are looking on Gust for opportunities to invest. So get it in, get the lower price. And like I said, if you need to use placeholders, please do, but don't leave the placeholders in there. Make sure you get back in there and change them out. Otherwise, it will not reflect well on you. So all of these sessions are recorded. We do have a playlist out on our YouTube channel, which is at Startup NV. The playlist is AngelNV Founder Bootcamp. So everything going all the way back to September 8th is recorded and available out there. This recording, we're going to edit out the dead spots and some of the other things, but it'll be available probably this weekend, and certainly by Monday of next week. So the Gust applications are open. You know the ways to apply for them. So the logistics for tonight, as soon as I'm done yakking, we're going to turn it over to Josh. He's going to present. As you have questions, submit them to Maggie in the chat, and not in the Q&A, but in the chat. And we'll either ask them if they're relevant as things are going along, or we'll wait till the end and start asking questions. And if things go as we expect them to, we'll probably be done with this by somewhere between 60 minutes on the short end and 90 minutes on the long end. And now next week, we are having we're having office hours. We're gonna open ourselves up to get specific questions asked for filling out your application. So if you're confused about something, next week at this time, we're gonna actually go online and fill out an application from a fake company. So you'll get to see us filling it out, making commentary along the way about what's important. What are critical things? What are some things that should be said in certain areas to attract angel investment? And then for those of you who are brave enough to ask questions about your specific things, we'll open it up to questions after that. And we'll leave the mics open as long as we have questions. If we start to get into a rat hole with any one particular person, then we may ask that person to go offline into a breakout room with one of our advisors, our panel members, to work through that. But we'll have some Q&A and some examples for people next week. But like I said, if you want to take advantage of the early bird pricing, just make sure you get in there with some placeholders before the end of the day tomorrow. That's when the price will go up. And finally, I want to thank our sponsors. These are the folks that that enabled us to put this boot camp on. Assure provides all of our back office systems for our angels to make their investment in you. They set up all the legal documents for the fund that will make the investment. Carta provides all of the cap table resources for us and have been a sponsor. Silicon Valley Bank is the bank that everything runs through. Arsentia is the company that was one of our first presenters, and they still have they're still making available to our founders their software that creates investor summaries for you, like a one-pager investor summary. So if you haven't taken advantage of that, or you don't know what I'm talking about on that, drop a note, drop a question in the chat, and we'll get you the link for that. City of Las Vegas gives us this great facility to do our events in, and the SBDC has been one of our strong financial sponsors here. And then we've got our community sponsors who have helped us get the word out and to their members, and support us on some of the other grant activity that we're doing to try to keep the bus rolling, the Startup NV bus rolling with federal grants. And finally, here's some contact information. I think most of you know most of this stuff already, but for those of you who don't, here it is again. You can reach us by phone at our general email address, or feel free to shoot me an email. Not during our session now. I won't answer then, but anytime after that. So thanks again, everybody, for coming out tonight, and for going through this whole process with us. And to whoever it is that ultimately gets the investment from the angels, awesome. And for those of us who are going through it together, learning from each other, thanks for participating and hanging in there with us. So I'm going to turn it over right now to Judy, who's going to introduce our speaker for tonight. So unless Maggie or Judy or any of our panel members come on and say, oh, Jeff, you didn't cover this, I'm going to turn it over to Judy.
Thank you. Thank you so much, Jeff. Good to see everyone tonight. So we're incredibly lucky to have Josh Geffon with us. Josh and I have known each other for probably 5, 6, 7 years. It's starting to add up. Josh is a corporate and securities attorney with 20 plus years of experience in the industry. He is currently a partner at Fenwick & West, a very well-established law firm with offices worldwide, obviously in Silicon Valley, Palo Alto. Josh is based in the office in Santa Barbara. And we're just really super stoked to have you here tonight, Josh. So thank you for making the time. And so we are going to talk about due diligence, the due diligence process, because that is something that all of our startups here that are applying for the program tonight, you'll need to make sure that you have that you understand that process, that you have all your documentation ready, that you're as organized as possible. You want to make that great first impression on your investors if they are seeking to do due diligence on you. The manner in which you present yourself through that process is going to be really instrumental on the relationship building with those investors. So Josh is going to give us a really good overview of that piece. And then after that process is done, that's when you start negotiating your deal terms. For most of the startups that are applying here tonight, it is highly likely that you will take on an investment pursuant to what we call a convertible promissory note. And Josh will touch on that and will give us sort of the key terms within that document that you need to focus on, and what the standard ranges are for those terms. For example, there's an interest rate you have to negotiate. The standard range is, and I'm just going to make something up, but might be between 5 to 10%. What's the accepted mid-range? So we'll talk about all that, just so you get a sense of when you do start having those negotiations, you understand what the standards are. And so you're talking in a manner that shows that you know what you're talking about, and you don't have to be as apprehensive if this is your first negotiation with investors. So with all that being said, Josh, thank you so much for being here tonight. Really appreciate it. And I'll let you jump right in. Thank you so much.
Judy, thank you very much for inviting me. Thank you all for having me Hopefully this is helpful for you all, and happy to be here virtually, of course. I wish I was in Vegas with the group, or Reno for that matter, but maybe next year we can all be post-COVID and happy, healthy, and raising capital together. So like I said, as Judy commented, I'm a securities lawyer. I'm a startup lawyer, really, and today's presentation is really to get from the slide presents, how do we get funding? How do you get funding to startups, and how do we walk you through this process? So if you can see my slide, you shake your head and say it changed, which is a good sign. That means things are moving forward. This is terrific. This is a nice picture of me when I had hair, or at least 3 hairs. Now I have less. I've been doing this a long time. I give presentations, but really the presentation tonight is talking about you and talking to the audience about how do you actually raise capital? You know, how do the things that you need to be mindful of when you're thinking about starting a company, which you've already done, how do you raise capital? What are the things you need to be mindful of as you talk to investors? And more importantly, what's the due diligence process to get actually a deal done? So what I'm going to do first is I'm going to talk about at a high level what the due diligence process is all about. What is due diligence? And then what is the business diligence, the legal diligence, and even the timing and process. And then what we're going to do is we're going to talk more specifically about what are those deal terms that you need to be mindful of once you actually get the structure in place. Once the investor says, yeah, I like your deal, I'm willing to give you some money. Let's talk. We're going to spend a little more time as we talk about through timing and process what a strategic investment looks like. So it's a preliminary matter. What I like to start with is just as a lawyer, of course, is defining the scope of the work, which means let's define what due diligence is all about. What do I mean by due diligence? You know, really, for those who are unfamiliar with the term, due diligence at a high level is basically an investigation of your company. It's an investigation and an analysis that an investor is going to do to make sure that if they give you a check at the end of the day, your promises, verbal and otherwise, that you've made to them actually align with the materials that you have in your internal repository. It really is, in other words, of saying it's a fact-gathering method to understand what your company is all about. I am having a bit of a challenge, so just bear with me. I apologize here. There, it's a little better. I want to make sure that we're all looking at the same thing. The reason this exercise is so important for investors is it does really 3 things. 1, it avoids surprises after the investment occurs. It actually, number 2, helps investors gather data to ensure that they know really what they're buying or they're investing in. And it, more importantly, proves or disproves statements and assumptions that they're making, or what you have actually made to them. They have to make some assumptions about their valuation, and we'll talk about that a little later, but they're basically established diligence exercises determined and utilized to ensure that the assumptions they've made to determine the value of your company is consistent. Here we go. I like this picture because I think it's actually helpful to understand a typical angel investor. A typical angel investor, as we've kind of already heard tonight, is someone who is knowledgeable of the space, who's probably been successful, him or herself, has a certain criteria that they're looking for to help, early stage companies. At the end of the day, an angel investor is a business person. And a business person who has expectations about what they're investing in. The due diligence process is designed to ensure that that business person's expectations match the documentation that we've already provided. By way of example only, I'm a startup company. I created a new T-shirt. It's a patented technology. And I've given verbal promises to that business person / angel investor that I invented the technology, that this cool looking T-shirt, this patented technology company is indeed a wholly new product line. That's what the promises I've made to investors. Investor says, wow, that's really cool. That's $1 billion business model. Well, what actually happens if the company didn't own the technology? Not me personally, but what happens to the company that investor's investing in didn't own the technology? Well, a couple things. One, obviously there'd be an intellectual property question. Well, if you don't own it, who does? Intellectual property is the rights of ownership. There'd be liability. If I invested in this company and turns out the technology was owned by a third party, there's liabilities there that third party may sue that t-shirt company. Ultimately, that third party who actually owned the technology may end up suing the company I just invested in. And they may put an embargo in place. They may actually say, you can't sell that anywhere. There may be production delays, there may be stoppages. Effectively, that money that I invested into that company that I thought was worth $1 billion, because that was $1 billion business, turned out to be worthless. And in the exercise of due diligence is designed to address at a high level and a thorough level as well, information that is available to help make the investment decision. I love this slide for three reasons. One, it kind of helps you think about life generally. Like, we all have information we know. Okay, we all know things around us. We know things to be true. Presumably, we saw the sunrise yesterday. Okay, that we know to be true. It actually occurred yesterday. We presume tomorrow that the sun's going to rise tomorrow. We know, we don't see it yet, but we know that we're going to presumably see it tomorrow. And in the scope of investing, we also, for instance, I go to a further level, there is a whole realm of things you don't know, okay? Putting aside the sun rising, thinking about designing a watch, okay? I know a watch is really useful for me to keep me on track, okay? I know there's certain valuable watches and certain watches that are less valuable. I know I don't know how to create a watch. In other words, how to create a watch. But I don't know what the next generation of watch is even going to be thinking about, how we're thinking about it. I don't even know how to envision it. The diligence exercise is designed on this screen to basically minimize the things we don't know, to identify the fact that there will be things we just don't even think about that are even on our horizon, but to truly get a sense of arms around the things we do know. Because if you are an entrepreneur and you're promising me that this patented technology is yours alone, well, that's easy to validate. And the diligence exercise is designed to validate those things. It's a move from what you know, it's designed to move from what I know I don't know to what I actually do know. And that's what the diligence exercise is all about. So as a result, the diligence exercise needs to be able to be occurring before the investment comes in. There's really two types of diligence. There's business diligence and there's legal diligence. The business diligence is fact gathering in support of a transaction to confirm the verbal communications the company aligns with. It's just investigation about the company, about the investment opportunity. It's when we think about it, it explores the management, the market, the product, the service, the business model. It's really designed to weed out those companies and entrepreneurs who may have made oral promises that the sky is blue and this is $1 billion market opportunity, but the business case isn't there. Okay, this is a timing and process slide. What I mean by that is, if it's an angel or a VC, the investor gets hundreds, if not thousands, of deals to review a year. Okay, that hundreds to thousands of deals they get to review a year start by a funnel in the initial screening. That initial screening is designed to quickly remove those deals that either don't fit within the investment criteria of the angel investor or the criteria that is deemed necessary for success. If it's an angel investor or a venture fund, they're often inundated with investment opportunities. They use processes and mechanisms to quickly screen out those deals that are not of interest. Those initial screening focus on investment fit, and they focus on investment potential. If you pass that initial screen, then you go on to the business diligence. If you pass the business diligence, you're going to get legal diligence, or you're going to get a term sheet that is subject to legal diligence. And ultimately, if you get past the term sheet and legal diligence, you get to actual transaction documents, convertible notes, perhaps a preferred stock financing, the actual substantive legal documents to effectuate the investment. This is an important timing and process slide, just to give you a framework for understanding from start to finish. If you find an investor today, it doesn't mean you're going to get checked tomorrow. This could take anywhere from a few weeks to more typically 9 months. And I want to put this out there for you because you need to plan early on how you're going to actually get through this process, because you may run this process through multiple investors, and some might actually fit the investment fit, others might fit the investment potential. But if you don't get your first two, number one, you shouldn't give up hope, because there are tons of other investors out there. Finding the right investor for you is more important than finding the right investor. And two, the timing itself, this is a standard process slide for all angel investors, a standard slide for all venture investors. Now, the horizons are different for different investors, and the different investment theses are different. But the point being is, just because you found somebody who you think fits within your investment thesis doesn't mean that you're going to actually consummate the deal. You need to plan accordingly. Okay. I've already talked about this investment screening. Is your business a viable business? Okay. I like this example because I'm talking Las Vegas. You're an ad agency. You go find that investor who's a New York-based investor because, frankly, he's friends with your college roommate who said, hey, he's a venture capitalist. He's a successful entrepreneur. But he turns out to be a late-stage med tech investor. He's in New York. He's probably not the right investor for you, right? So what you're looking for, and I'm sure this has been articulated by other folks, is that you're looking for angels and other investors that align with your business because it's the right stage, the right geography, the right size, even just the right investment sector. And this is I think, helpful to envision. Not all investors are the same, and I'm sure you've already understood that. But you might actually find somebody who invests outside of his geography, but actually loves what you're doing. If you're in Reno and you're into gaming, okay, and there's creating a gaming app, it's not that all four of these have to align. It's just that these are the types of investment criteria that people, envision their investments rotating around. Likewise, it's not just about finding the right investor, it's about finding the right investment opportunity. Is your investment the right business model? And we're going to spend a lot more time on this throughout the slides. Okay, but what I'm trying to address is if you're taking notes on this slide, or taking notes on this presentation more generally, you should always be asking yourself, and I'm sure people already asked, who's on my team? What's the market opportunity? What's the product, the service, the business model that I'm actually meeting? Okay, it's really no secret that angel investors are looking for large, high-growth markets. In fact, it would be surprising to see a business plan that doesn't suggest a significant market. The ability to clearly articulate why a particular business proposal will experience rapid market growth is essential. Okay. The product or service. The key to evaluating a product or service is to ask, what customer problem are we actually solving here? And once that understanding is clear, the next question is, can the problem be solved profitably? You know, on the business model, in evaluating the business model, you want to determine that the business plan tells a compelling story. How is your business going to make money? You know, how will you operate it over time? It's really this idea of growing your business, and is it a sustainable business? Okay. Let's go back to this last point about initial screening, because you're trying to get past that initial screen. Does your pitch even impress investors? So I like this because I represent several angel investors. I actually represent a lot of VC funds too. And Will Rogers said it best when he said, you never get a second chance to make a good first impression. Okay. If investors getting 1,000 deals a year stand out, how do you make the right impression? I often use the term, this pitch deck that you're putting together, this is your resume. So make sure you don't have any spelling errors, right? Make sure it looks good, that it tells a compelling story, okay? Like I said, I wanted to talk a little bit more about kind of the fundamentals of what investors are looking for. And you've probably already heard it differently, but I want to state it from a diligence perspective. From a diligence perspective, investors are looking for your DNA, okay? They're looking for how your team operates. You'll be working together a lot. You're going to be working as a team together, and you're going to be working with your angel investor a lot. Is that angel investor going to be the right team member for you? Are they going to be the right supporter? If there's a friction or the slightest possibility of a lack of chemistry, it's probably not going to work. You guys are going to work, and you probably already are working, you know, long hours, weekends, week outs. And you're asking, is this what it's going to be like for the next 5 or 10 years? Yeah, that's typically, the answer is yeah, that's typically what happens. Once you get the money, then you're, you know, on steroids. Then you're running even faster than you're running now. And your investors are going to expect you to do it. So the answer, if it ever comes up, is why you're doing this shouldn't be because I want to be my own boss in my mind. The answer should be because I'm solving a problem that nobody else has thought of. I'm creating a new business opportunity. I'm doing this long hours because we're going to have this huge business opportunity. Okay. You got to be of good health, sound mind, and you got to be excited about the market opportunity. Okay. Investors are looking for the right tactical and strategic discussion. They're looking for the right fit. Are you the right person, and is your team the right level for the challenge? So you're going to describe your passion, your drive, your ability. And this is important for investors, because oftentimes my investors say they're actually more excited about you than they are about your product. You may end up pivoting 3 or 4 times, but as a team going to be together to see that pivot, okay? This is all under business diligence, right? So the angel investors are asking, who are you, right? How do you guys function as a team? Do you have the mindset? Do you have a leadership ability? Do you even have the, obviously this sounds obvious, but do you have the honesty, the integrity, the good judgment to lead the organization? Okay. So one person said team, team, team. Many of my investors say the same thing. They think it's very important. And I think that's important for your deck too, for your slides and for your diligence. The other slide, I think, is market opportunity. Okay. As a business diligence, do you actually have $1 billion market opportunity? It's not just about what the overall market opportunity is that what is it that you're going to address as a huge business opportunity? And how will your business proposal serve your addressable market? Who are your target customers? How are you going to reach them? Who are your competitors? How do you intend to minimize those competitive threats? This is business diligence that your investors are doing on your business. So if you're upfront addressing these things in your deck, if you don't even have it in your deck because it's too long to answer, but this is part of your pitch and your presentation and your business diligence, this is how you get past this business diligence stage, okay? Your investors are trying to think about who are the users of your product? How many of them really are there? What are the drivers that are fueling your business's growth? How is your company positioned against its competitive threats? Is there somebody else out there who's going to do the same thing we're doing tonight, same exact business model but cheaper? Are there alternatives out there that you're trying to capture but you can actually do a better job? It's not hiding the ball from your investor. That's not what business diligence is all about. Business diligence is identifying what the substitutes are and overcoming them, okay? I actually think this is helpful to think about from a unfair competition perspective, okay? What I mean by that is, how will your product or service deliver value easily replicated? How are you sufficiently nimble to stay ahead of your competition? How is your business scalable? Okay. Another way of saying this is, what is the challenge that customers are facing today? And what's the unresolved problem? I think what we're trying to say is, are customers willing to pay for your product to solve that challenge? Okay. It's a big business opportunity, and people are willing to pay to replace the incumbent. Okay. Why would somebody pay an extra $5 out of their pocket, hypothetically a month, to solve a problem? And what is that unfair competition, that unfair advantage, really, that makes you better than the rest? I like this slide too because I think it's always talking about scale. Okay, it may take you years. This is not always a linear equation. Okay, this is a little bit linear, but that's not how startups often work. It takes years of diligence and toil to actually see an uptick in numbers. Okay, it takes years to find the stride. But how do you expect to drive that uptick in growth? Okay, how are you going to create money for other people? How are you going to sell your product? How will customers perceive your value? Are there other companies out there that, like, if an investor was thinking about, that they could benchmark against? How much money is it going to take to get to where you want to go? This idea of scalable means it's almost like repetitive business, that you're making money on the money. Think about a drug. Literally, like, a good example today is a COVID vaccine. How much money have people invested to create the vaccine? The intellectual property is already sunk into it as a fixed cost. But once they actually create the vaccine that's scalable, what are the margins going to be on that? It's not about COVID. It's actually, and it's not simply about a vaccine. It's just a simple example of, it takes almost $1 billion to get a drug to market. But at the same token, once you get that drug to market, it becomes a $10 billion market opportunity or a $100 billion market opportunity. A SaaS business is the same model, okay? A SaaS business is what's reoccurring. You invest a little bit of money to create a reoccurring revenue. okay? You know, it's high gross margins. What makes you an attractive investment? And what's your exit potential too? This is one item. This last slide, I give it short drift here, but investors often ask you, and I'd make a note that if I was just taking notes on the slide, I'd say, what's your time horizon for the investment? If I gave you $1 million today, when do I expect to see a return on that investment? Okay, that return on the investment comes from a liquidity event. The liquidity event is as a sale of the company or an IPO. Those are basically the only two liquidity events. Those are only the two ways angel investors are going to see a return on their investment. Okay, that is effectively the exit strategy. How many years is it till I get a return on my investment? What is your exit strategy, and what is a realistic return? And ultimately, it's not what's going to be the exit model and how am I going to get a return. How do I get, if I give you $1 million today, how do I get $100 million in 5 years from now? What's that investment thesis that we're trying to accomplish? Okay. Some people call it getting to cash flow positive. That's only a small piece of the overall pie. It's important. It's really important. But for an investor, it's what's the exit strategy? Because getting cash flow positive is I give you $1 million and then I fire everybody. You're cash flow positive if it's only you taking my money and you're selling, you know, 100,000 a year. That's not what we're talking about. We're talking about how do you make money for the investor. So far to date, that's the business diligence, and I'm happy to take questions at this time, or I can keep going and maybe take questions on diligence at the end, because as we've said, this is a business diligence and then a legal diligence and then a process/transaction discussion we're going to have. So far, let me take a step. Anybody have any questions they want to ask in the chat so far?
Hi, Josh. No, we really don't have a lot of people with questions so far, but they were, I'm sure, just raptly listening and taking notes. So some you asked them for questions, so they may pop up. But if you want to start into the next topic, maybe you can deal with business diligence and legal diligence questions at the same time.
Fantastic. Thank you. That's really helpful. Because sometimes, in fact, if you have questions, put them in chat. We'll answer them. Also, the business and legal diligence are often the same. It's what I'm talking about today is once you actually get past the business diligence, you got to actually survive legal due diligence as well. You know, you have to actually support the commentary that you have provided your investors with actual documentation. Okay, you need to confirm the documents, that you can confirm the oral statements you've made. And it's more than just a lawyer reviewing your documents. It's helping the whole team, the whole investment team, understand your investment thesis and, you know, back channel to confirm that what you've made representations about are in fact correct. And there's no patent issues, items that you may have otherwise verbally thought about, but hadn't even either verbal representations you made or things you haven't even thought about that are material to the investment decision, which we'll see in a second here. Okay. I break legal due diligence into basically 7 categories of items, and we're going to go through those in a second here. But this slide is important for those who are just listening to legal due diligence for the first time, because you will get from your angel investor, from your VC, a due diligence checklist. And it could be literally 14 pages long, or it could be 5 pages long. It might even be 2 pages long. But at the end of the day, all of the questions that are listed on that due diligence questionnaire are organized into 7 overall buckets. Corporate records, what does your company actually look like? Are you in fact a company? You know, business plan and financials. You made representations maybe about how many sales you've done. does it actually support your financials? You tell me you've got $100,000 in revenue, recurring revenue, month to month. Does that actually show up on your financials? What's your stock grants look like? How many people are actually on your capitalization table? The capitalization table we'll talk about in a moment is your stock ledger. How many people are on there? How many people have you promised equity to, either verbally or in writing through offer letters, even if you actually haven't made grants yet? What's your intellectual property? Again, all these slides are going to go into a little more detail, but I just want to give you a high level of agenda what we're talking about here. Intellectual property is, what does your IP portfolio look like? Who owns the intellectual property that you said you either own or have licensed in? And does it match actually your verbal communications? What do your material contracts look like? What does the inbound payments to your company look like? What does your outbound cash flows look like based upon your contracts you've already signed up to date? Is there any litigation out there? Are there any threats of litigation, either related IP or otherwise? Have people threatened to sue you because you haven't made good on obligations that you've already had to date? And then ultimately, what does your employee base look like? In California in particular, this is a very sensitive subject because we have a very employee-friendly jurisdiction. Nevada is slightly different. There's a little bit more employer-friendly jurisdictions out in your state. I've actually had clients, and it's been surprisingly employer-friendly in cases, and that's great for the employer standpoint. It doesn't matter for purposes of promises to if you're giving somebody, you've promised to give them $1 million a year as salary, or if you put $100,000, a month into a 401k, those types of obligations are going to come up in this diligence, and that's going to be a problem for your investors. Okay. On the corporate records, this is on the left side of this slide, and every slide you're going to see these questions. Okay, this is the types of questions that come up in the legal due diligence questions. They want to look at your corporate records. They want to look at all your board and stockholder actions. People want to look at where you're qualified to do business, actually where you're generating revenue, who are your officers, who are your directors. At the end of the day, your corporate records, which by the way, these bullet points on the right, these are the questions that they're asking. And at the end of the day, what we're trying to do is understand what your company's books and records look like. Okay? What we're trying to do is look at your corporate records. Are you actually a business? Are you an LLC? Are you a corporation? Do you have, and sometimes people forget this, that they are an S corp, even though they've organized as a LLC? There's different tax implications for you. Are you a Delaware corporation? Are you a Nevada corporation? Are you a Bermuda entity? Okay. So what kind of entity are you? Are you not even an entity? Are you just doing business yourself and you haven't actually got through it, which is often, more times than not, a surprise to sometimes their entrepreneurs who are like, wait, I have to incorporate? Well, yeah, you do. And there's some good reasons why. Okay. If you are incorporated, you're supposed to have meetings of your board, and you're supposed to have actions of your stockholders. Have you actually done that? Are you generating revenue in certain jurisdictions? And are you collecting revenue? Are you qualifying new business because you got 20 employees in Wyoming, and you got 3 founders in Florida, and you got 1 person in Romania? Where are you doing business, and who is on your team? And what does your team look like? Who's that executive leadership? The question I asked from a business diligence: who are the people who are strategically directing the organization as directors, and who is the C-suite? And again, it's a founding team, a really early stage startup. It's probably the same group of people, but are those people? Do they have arrest records? Do they? For gaming, that's impossible. If you have an arrest record, you shouldn't be in the gaming industry. Okay. Well, these are the types of questions that investors are going to be looking at. So understanding who's on the team is really important. The business plan and financials is really a question of all those oral promises you've promised me. Does it reflect on your financial statements? Does it line up? There may be real problems with your financial projections. You said you're tackling $1 billion problem and you've got, an addressable market of $100 million, are your assumptions and your projections reasonable? Well, we're going to see those in your business plan and your projections. They may not be. What's your sales cycle look like? Sales cycle is a key issue that's often too neglected by angel investors. And if a plan calls for selling it to the government and financial model shows sales closing in 2 months, the model's unrealistic because the government orders take about 12 months. How are your financials look like? You gotta kind of focus a little bit as an entrepreneur on your projections and be, rosy, but not too rosy, okay? Because, blanket statements that we're going to grab 10% of the market share is really not going to be, hold much water if people start digging into your financials. It's like, well, how are you actually going to do that? You got to worry about cash flow timing, reasonable expenses. These are, I could spend an entire hour on business plan and financials. That's not my intent. My point being for this slide is you should be prepared to provide your financials to your investors, because your financials and your business plan should really closely align with the oral representations you've made to your investors, because you don't want to lose credibility as you go through this legal due diligence. Okay. Let's see. I've already addressed this a little bit earlier, but your stock issuances and promises of stock is really designed to identify everybody who should have equity and does have equity today. Okay, I have a lot of questions around equity because this is typically the one thing that entrepreneurs tend to mess up on more than most, particularly because you're moving fast and quick, and you forgot that you promised your next door neighbor 50% of your company if they spend 10 hours on your company on day one, and you forgot that you've got a written agreement with Josh Geffon, hypothetically, that if he does this one small piece of your company, that they're going to have something called non-dilutive equity for infinitum, and they're going to own 10% of the company. Do your written agreements and your verbal promises match what you think is actually here? This issue is less about what's in writing and more about what's not in writing. Okay, it's more about you're moving fast and quick. Did you actually paper everything you've promised? And if I had to give you one piece of advice tonight, it's document, document, document. Okay, write it all down and make sure there's an agreement with both parties. Okay. Oh, and obviously point 2 is we can get into it later if you have questions, but never give non-dilutive equity away. Non-dilutive means, look, for now until the next 5 years, I'm never going to have less than 10% of the company. It doesn't work like that from an entrepreneur's perspective, even if you think that's a good idea, because if you take money from your investor, they're going to dilute you, entrepreneur, and you're going to see that a little bit later in this presentation. The person no longer providing services to you, sure as heck should be in the same situation as you, the entrepreneur who's toiling away late at night. So non-dilutive investment is a bad idea. It's different than non-dilutive from an investor perspective. It's more of entrepreneurs making non-dilutive promises to other co-founders. Okay. Intellectual property, obviously, this is critical to every startup. Who owns the intellectual property company? When I mean intellectual property, I mean, do you guys have any trademarks? Do you have any patents? Do you have any copyrights, domain names? Do you have any documentation relating to the transfer of intellectual property? The soft idea. You don't actually have to have a patent to have a really successful company. Okay? Intellectual property comes in many different forms. Okay? But the intellectual property at the end of the day either needs to be owned, and write this down, either needs to be owned or licensed by the company, not the founder. the founder needs to assign the intellectual property to your startup company. And that accounts for everybody around the table, even if they're not a hardcore engineer. Because if you ever watch the movie The Social Network, even the business plan guy has some IP here. And that is, by definition, the business plan is intellectual property, as are your customer lists. Okay, this is all intellectual property. Okay. Intellectual property is not just about what you own, it's about actually what other people own. It's ideas about, if you have two hot dog stands side by side, and hot dog stand 1 has something unique, going back to it's got a patented bun, okay? Hot dog stand 2 can't copy that bun, okay? That you can't, even if it sounds patented something. So the idea is that it's not just about what you own, it's about what you don't own, and not infringing on other people's intellectual property. Okay. Material agreements is just it's just what it sounds like. Are there a bunch of promises in writing or verbal agreements that you've agreed to pay a lot of people that is going to ultimately impact your financial projections that you forgot to include? Okay. Happens all the time. Hey, I forgot that I've got a lease, which is probably the most expensive piece of outside of employees. And that lease is an obligation for $2 million because I've got 200,000 square feet. It's a promise I really can't get rid of. What do I do? Okay. And in COVID, people are working remote more than ever. I can't tell you how many times my startup clients since March have asked me, how do I get out of my lease? I'm like, well, number one, it's not that simple. And two, the landlords themselves are struggling with this as well. So you got to go talk to a real estate attorney to figure out what your options are. It happens to be an obligation. It's not just about obligations, about acquisition agreements. If somebody made an offer to buy your company, that's part of the equation. Have you made promises to advance money to a third party, like an employee? Those are all the types of things people are looking for. Again, disputes and potential litigation. Again, kind of obvious, but are there issues that we're trying to address? Latent, active, prior, anything that might turn into litigation that cost you money without dealing with that. Employee benefits, what's the comp look like for people? Are there any severance payments? Typically, the angel investors particularly don't want to have large executive employment agreements. They don't want you to actually have a multi-year agreement with your executives. So the advice is try to do offer letters, put together at-will employment agreements that are short-form agreements. At-will employment agreements allow people to quit any time and allow the company to terminate people for any time. Okay. So again, this presentation was kind of designed to be diligence, and we've talked about business diligence, we've talked about legal diligence. The next slide, and we're talking, I want to move into the next piece, is the transaction documents. Let's say you get through all the fantastic exercise of the legal due diligence, which is, again, time consuming and difficult for the entrepreneur. It's probably the harder thing to do. We actually turn to the definitive documentation. Judy called it the convertible notes. I'm going to talk about convertible notes in a second, but I wanted to just spend a few minutes talking about the transaction documents, preferred stock financing. Okay, the preferred stock financing is you're the entrepreneur, you own common stock, investor comes in on top and owns preferred stock. The investor, the angel investor, may give you a check for a convertible note, which we'll talk about, or they may say, I want to own X percentage of the company. Okay, they say, I want to own X percentage of the company, and these are the rights that I want to own attached to my investment. Okay, that comes through a term sheet, and it comes through a pro forma cap table. A term sheet is a executive summary of the deal structure. It happens for convertible notes. It happens for preferred stock financings. It even happens for acquisitions. It really outlines the principal terms in summary fashion of the transaction. This slide and the next are a typical term sheet for a preferred stock financing. Okay. It talks about how much money you're going to get from the investor. It talks about the pre-money valuation, which means it's just the percentage of the company you own before the investor comes in. It talks about who the investors might be. It says that the investors will get paid out before the entrepreneurs. That's what the whole point of preferred stock is. If the company does really well, the investor has this right to convert into common stock and get their percentage ownership. There's voting rights that are attached to the stock. Okay, they get the right to vote alongside you, the entrepreneur. Each share counts for one security. Plus, on a preferred stock financing, the investor gets outsized voting rights because they get protected provisions. They get the right to block the company from doing certain material strategic transactions. That voting rights is broken into 2 points. First sentence says voting with common in all matters. And second, this is a term called protected provisions. The unique approval of the preferred stock gets the ability to prevent certain strategic transactions. Okay, and this is a litany 1 through 7 here of the types of things you'd otherwise expect. The angel investor gets financial information about the company. The angel investor gets the right to put more money in the future to keep their same percentage ownership. They may even get a place on the board of directors. And if there are rights that the series seed investor in this term sheet, see this? We got series seed up here. Here, I'll highlight it just so we're all on the same page. Highlighter. Series, sorry about that. This is a Series C term sheet. There it is. It actually worked, which is nice. The Series A investor would have similar rights to the Series Seed investor, and the Series Seed investor might be asked for the same rights as the Series A investor. One thing I haven't talked about at all, but it's important for an early stage entrepreneur, is to understand in 3 years from now, you entrepreneur have a team of 3 or 4 people you've kind of developed a team around. What happens if you're coding late at night and 2 other members of your team have walked out and have gone to go work for Google or have gone to work for Amazon? What happens to you? Well, if you don't have repurchase rights in place, which is the right to repurchase the shares offered by the other co-founders, you're going to be disappointed that other co-founder has a large percentage of the company. And so one thing we term sheets often have, and one thing I would put as an entrepreneur, is this idea that have this concept of repurchase rights. Okay, have this right to make sure that everybody sticks around. Okay, sorry, my slide is going crazy at the moment. All right, let me take the next step. I've given, I'm throwing about a bunch of terms, but really at the core, what we're saying is there are 3 founders of a company. In this example, I've got George, John, and Thomas. Okay, they all own a certain percentage of high-tech company. Okay, George owns more than John and Thomas. But what happens if John takes a job with Google and Thomas takes a job with Amazon? Well, if we don't have repurchase rights in place, George is going to be coding late at night and kind of annoyed that John and Thomas own a large percentage of the company. They own, in this model, I've given 25 or 15% of the outstanding stock. This example is called a capitalization table, by the way. If you're taking notes, this is called a capitalization table because it lists who owns what of the company. And it describes the ownership percentage. This line called pool reserve, this is available shares. These are shares that are available for future employees to own. This is to be used for other service providers. You could use it for advisors, employees, consultants, that you can allocate equity to those people in the future from this pool reserve. Currently, those shares are not outstanding. They're just reserved for future issuance. So the outstanding numbers that are listed here, and this, by the way, I love Carta. Number one, they're a client of ours and love them to death. Two, they make every one of my startups better because they help keep your cap table. They help keep your cap table looking like this, okay? And the reason I say that is in Carta, you will see it broken out by outstanding and fully diluted. Outstanding is just the percentage ownership on a voting basis, okay? Carta is the cap table company that's going to help you understand who owns what of the company. And the outstanding number here is what percentage ownership do I own on a voting basis today? The fully diluted basis is the percentage ownership after the pool reserve is fully allocated. One more point here before I go on. As you're taking notes, you're thinking about this like, well, what does it actually mean? It means George owns a majority of the company, full stop. Okay, John and Thomas are in the minority position. So George can really direct the company because he owns the majority of the company. The stockholders direct the board. The board of the company directs the direction. So the board directs the strategic direction of the company, but ultimately the board is beholden to the stockholders. In this model that I'm presenting here, George, because he has the straight up vote, the majority of the stock, can direct who should be on the board. Okay. The question that came up is really good. Does the fully diluted section include outstanding but unconverted options? Yes, it does. One more time. The question is, does the fully diluted percentage including outstanding options? It does. And I use the term here, outstanding, to mean voting rights. Some people include outstanding to include outstanding options. Either way, it does not matter. What matters is the fully diluted number includes everything to date. And here's why this matters, okay? It matters because James is going to put money into the company. On that term sheet, I've allocated a couple of slides before, which I'm going to go back to in a second here. James is going to write a $500,000 check into this company. James wants his 20% of the company. James wants his 20% of the company on a fully diluted percentage. He does not want to be diluted by all those promised options and by all those pool reserve that may be allocated immediately after the money comes in. So let me go back here, if you don't mind, if you bear with me one more moment here. I'm going to go back to the slide where I've allocated the investment opportunity. This is, again, the preferred stock term sheet. This is a summary of the terms. And in this slide, we've got James who presented the term sheet to High Tech Company. High Tech Company were all the other entrepreneurs before James. And James says to them, I want 20% of the company for $500,000. Okay? James says, and I want to make sure that you have enough shares in the pool to make hires after my money comes in, because my money is not just to go to you, George, and the rest of the team. My money is for you to go actually hire a few more people. So I want to have 10% of the company available for future issuance. For all those new employees, I want it to be 10% available option pool. Okay, that's listed right here. And by the way, that 10%, I don't want to be diluted by I don't want to suffer dilution by that 10%. I want you entrepreneurs to suffer dilution. Okay, and he does that by saying a pre-money valuation of X, including an available option pool. In the worksheet I showed you, the worksheet I showed you, after the investment, if we didn't increase the option pool, it would have only been 8%. Because even though the slide's got 10% here, investment comes in and dilutes everybody. So we have to increase the option pool. By the way, Bill makes a good point. He said the typical range is 10 to 20%. I agree with that entirely. If we didn't increase the reserve in this slide, it would only been 8%. And the entrepreneurs are going to basically be diluted because the angel investor, James in this scenario, says, I want to be 20% after that increase in the pool. Okay. I don't know. I don't know how familiar you are with cap tables, but let me take the next step here. Okay. One question that I get all the time is actually, how do I figure out how many shares to sell? Okay. It's actually, hold on a second. It's a pretty interesting theory here, which is Chip asked, let's kind of talk about it a little bit more cap table. So what I like to do is tell my entrepreneurs, use Excel. Number one, that's really helpful. And just like Excel in this slide, what I like to do is list the entrepreneurs, who owns equity today. You put that in column A. Just list the people's names, and if everybody's got the same security, you list it in column B. You put the number of shares in column B. Okay. If you have an option pool, you would list that you would put that in column C. You'd say outstanding options. And if it wasn't, in this scenario, if we continue this analogy, I guess I would have Abe Lincoln, okay, having an outstanding option. And he'd be, row D. Abe Lincoln's got, 20,000 shares under options. He doesn't actually exercise his options. He's got 20,000 options, okay? And then you've got a pool that's reserved, and you would have 20,000 options of the 1.1 million that are listed here. And so the total, the available reserve would be 1.1 million that's listed here minus the 20,000. That's the available pool for the future grants, okay? And that's a simple cap table. That's the number of shares outstanding, okay? You got the outstanding percentages, you got the fully diluted percentages. Again, in my model, and Carta can help you as well if they're great to help you with this. It's just a conception of who's got voting rights, and then what's the fully diluted percentage. What does it all look like? So let's continue this equation. And this picture here.
Hang on one second, Josh.
Yep.
We had an earlier question asking you to address the different legal organizations that companies can be and which states are the best states to incorporate.
Let me answer that. That's a great question. I love it. Let me come back to it in 1 second. Because and the reason I love that question, but I also want to identify the fact it doesn't matter the jurisdiction of incorporation. If you're a Nevada corporation, if you're a Delaware corporation, if you're a California corporation, or if you're an LLC, this type of equation occurs all the time. This is applicable for all the types of entity and the jurisdictions of incorporation. Okay. If I'm playing through this analogy for a moment, this hypothetical, in my term sheet I said the pre-money valuation is $2 million. And I said that's everything included, okay? That's including the option pool refresh, okay? And the option pool refresh is this 317 number, okay? So the option, what you're going to take is the number of shares outstanding, which is the 11 million number. You're going to include the option pool refresh of 317460. And by the way, it's an equation that's repetitive. So you actually have to use iterative functions on Excel if you're using Excel. But that's your pre-money number of shares. You take the valuation, divide it by the number of shares outstanding, including the option pool refresh. Well, actually, on the fully diluted number, pardon me, not the outstanding refresh. You take the fully diluted number, and you come up with a price per share. Okay. You take $500,000 divided by the 17 cents, and that's how you get the 2,857,143 shares. If you don't like that, what you could do is you could take the post money. Ironically enough, you could take the 14 million number if you wanted to, and multiply it times 17 cents. That'll actually get you to $2.5 million in shares. Okay. I know there's some great questions about convertible notes and how do we deal with, how do you actually factor in pricing on convertible notes? I will get to that as well in a moment. What I also want to say is when you're thinking about a priced round, and obviously I'm doing that, it's not just the term sheet you have to be thinking about. You also have to be thinking about the transaction documents. In a priced round, and the reason I want to mention this is about 90 pages of documents for a priced round. So it's not a simple process. Now, there are templates available, and that's what lawyers are for, to help you work through this. But it is important to understand that once you get a term sheet signed, on that process standpoint, there's still a lot of work to be doing. There's still the legal due diligence. If the investor just wants you to sign a term sheet and then do this legal due diligence, and there's the definitive documentation, which is all of these documents here. It defines, it basically puts pen to paper the summary of terms that have occurred to date. Okay. Now, one question has already come up is like, hey, what jurisdiction should we be dealing with? Should I incorporate in Delaware? Should I incorporate in Nevada? Should I incorporate in Florida or California for that matter? We did an internal analysis at Fenwick. Actually, we did it in March because I had this exact question. And surprisingly to me, actually it was quite surprising, 98.5% of our companies, 98.5% of our companies are incorporated in Delaware and ultimately qualify to do business in California. Now, what does it actually mean? And does it matter if you're in Nevada versus California, does it really matter? Okay, what incorporation means is you are availing yourself of the benefits of the state of incorporation. You're availing yourselves of the legal and fiduciary duties that are attached to the jurisdiction of incorporation. And the reason why 98.5% of our companies go to Delaware is because the S&P companies go to Delaware as well. It's because Delaware has a rich judicial history of corporate governance. And number one. Number two, if there's a dispute, Delaware has business courts that are utilized by the largest corporations in the world and the smallest corporations as well. Now, Nevada's gotten smart, and I give Nevada a lot of credit for this, because Nevada has designed its corporate statutes to emulate the Delaware corporate statutes. It's intentional, okay? It's not about the tax haven in Nevada. It's actually, it's designed to encourage businesses to do business in Nevada, to avail itself of the Nevada statutes. And Nevada has a phenomenal statute for fiduciary duties. The challenge I have in Nevada is that they just don't have, your state doesn't have a lot of the rich corporate history that Delaware has to date. Okay, so I can give you, if you incorporate in Nevada, I can give you similarities to what Delaware courts would do, but there's not as much rich corporate history as Delaware. Let's say Google, as we all know, is actually based in Palo Alto, but they're a Delaware corporation. Even though they're Delaware corporation, they actually, quote, qualify to do business in California. which means they avail itself of the California laws because they have employees in California, and they actually have to pay in people, and they've got to get leases. And qualifying to do business means that you pay taxes in California and you sign commercial contracts in California. Okay? So same thing's true in Nevada. If you've already organized your business in Delaware, hopefully you've qualified to do business in Nevada, and therefore you can avail yourself of the courts as appropriate for commercial contracts. And if you ever get sued by employees, you can avail yourself of the California or Nevada statutes as appropriate. The other question that came up is, what type of entity should I be? Should I be a corporation? Should I be an S corp? Should I be a C corp? Should I be an LLC? What's the difference? I generally advise, and our firm advises, if you're going to raise venture capital financing, you generally should be a Delaware C corp. We've already talked about why Delaware, but the C corporation is the type of entity that's a non-pass-through tax entity. Okay, it's a non-pass-through tax entity, which basically means if the corporation were to pay its shareholders a distribution, like it made money and it was actually had revenue to pass on to its shareholders, it would be taxed at the corporate level and it'd be taxed at the shareholder level. And you're like, well, that seems opposite of what most of the accountants advise. They usually advise to get a single entity pass-through entity. And the reason we typically advise to be a C corporation, not an LLC, is the VCs themselves want you to be a C corporation. So if you're already going to raise venture capital financing, you're going to have to be the C corporation anyway. Might as well get started with it. It's usually more efficient to start as a C corp versus an LLC, and it's less labor intensive. I have consumer product companies that I work with. It just happens to be that some of my clients are, like I work with L'Oreal, for instance, and I work with certain companies that are not capital intensive businesses, and they really like the LLC model because they don't actually need to go get venture capital financing, and they're going to be able to generate revenue quickly. That is probably the only reason, and they're not going to raise venture capital money. That's the reason why they should be an LLC, not a C corp. Okay. The problem is to set up an LLC, because it's a blank sheet of paper. Literally, it's a blank sheet of paper, and you're able to draft whatever you want and kind of dictate terms amongst the parties. There's really no great way to do it super cheaply unless it's just you getting your company started. Okay. The other reason I often tell people you should start as a C corporation is something that investors know but entrepreneurs don't appreciate, which is called qualified small business stock, QSBS. Qualified small business stock is a tax benefit for entrepreneurs and investors that invest in companies that have less than $50 million in assets, and you hold the stock for 5 years. Well, if you start as a C corp, that's when this 5-year hold period starts. It's a huge tax benefit because you get the better of 10 million basically federal tax free, or 10 times your basis. If you're an investor and you put 10 million bucks in, that's $100 million tax free in the federal level. For an entrepreneur, when you're paying, tenths of a penny, 10 million tax free is a lot of money. It's life-changing money. If you start as an LLC and you convert to a C corp, the clock starts on the 5-year hold period once you convert to the C corp. The other point I'd say on this is an S corp is like an LLC. An S corp is a tax beneficial treatment for startup companies. Okay, it's designed for sole proprietorships. S corps do not allow multiple tiers of investment, so you couldn't actually be an S corp and actually do a preferred stock financing. You lose the tax benefits. The bigger problem for the S Corp is if you start as an S Corp and you want to raise capital, you have to re-domesticate. You have to go to a different jurisdiction and start a whole new company. So if you're going to go out and raise venture capital funding, period, we don't recommend you start as an S Corp. And if you do start as an S Corp, you can't get the 5-year hold period until you convert to a C Corp in another jurisdiction. Okay? Again, so I talked about, I've gone through a lot of stuff, I recognize it, and there's like, wow, probably blowing your mind. But what I'm basically saying is step one, if you're going to start a company you haven't organized, I typically advise starting as a Delaware C Corporation for both tax benefits and to get the benefit of the Delaware corporate law. Two, I recommend thinking about the long-term exit strategy, holding the stock for 5 years. Three, I recommend, and we haven't, and I'm about to address convertible notes. I recommend getting your ducks in a row up front. What it means is the due diligence process is effectively designed to look at the contracts you've put in place. So you got to find ways to make those documents on day one clean to help make a smooth investment from your angel investors and your VCs. It's hard enough to get past the screening proposal. There's so many great deals out there. Okay, so what you really want to do is run a professional, proactive, proficient process to help the financing, and this diligence process is important to consummate that preferred stock financing. All right, so I'm going to give me 2 more minutes here because I'm out of time, but I know I said I would talk about convertible notes. So, and I see there's some great questions already coming along. So this is us. This is a nice picture of Nevada. That's my short presentation. It's a little longer than short, but still bear with me 2 more minutes if you don't mind.
No, we have time, Josh.
Don't worry about it. We have time. Take
All right.
Take
Okay,
your time.
cool. All right, so I'm going to talk about convertible notes. I wanted to ask, there's a couple of quick questions that came up, and before I turn to convertible notes, that might be helpful since we're talking about structural questions. I think Selena was asking, Selena, I think you're saying you were a Nevada LLC, you converted to an S Corp. Should I now convert to a C Corp? Am I right? Is that the right question?
Yep, that's how I read it too.
Okay, great. So, thank you. So, that's an interesting question. I would probably, if that's an interesting question. I would probably, let us say you converted from a Nevada LLC to a Nevada S Corp. Okay. As you are looking for your first equity investment or your convertible note offering, as part of that investment, I would go to Delaware. I would start as a Delaware C Corp. Okay. But I wouldn't spend the money now to do it. I would only do it at the cusp of financing to make sure that actually your investor is aligned with your long-term investment strategy. So it's almost like it's going to be a shift to your business. It's going to cost you money. Don't rush into it. Make sure there's alignment there with everybody. If your angel investor is saying, well, I'm going to actually give you money and I'm going to convert into a security that's going to be above the common, by definition, you can't be an S Corp. So you got to be something other than S Corp. I just don't want you spending the money on day one. I'd rather have you kind of structure it properly in alignment with your angel investor. And I'd probably do it as a Delaware C Corp at that point. Okay. I think we're asking about cash flow and cost to do a financing is what my understanding would be, as I think the question. The cost to consummated financing, quite frankly, is all over the board. And I don't want to pigeonhole myself in, and you guys go talk to a different lawyer or talk to, you know, a local investor. And my only thought would be is, it depends where you are in the financing stages. It depends how clean your company is. It depends on what your angel investor wants on the terms they're expecting. And I would encourage, you know, you to talk to, you know, a couple different lawyers and see what their offers are and their experience, and kind of get the right fit for you. Not all lawyers are the right fit for everybody else. Okay, and not all lawyers are the right stages for the right companies either. That's all. Just asking if they're the right person for you is the way I like to describe it. All right. Okay, so
Josh, there's a new question in there, and Bill, who is also a panelist, has a question about the option pool. And so I'm going to actually let him ask that question. And the new question, well, there's two now. If I registered as an LLC, say in Massachusetts, can I use the same name and maintain the same EIN if I decide to register as a C Corp in Delaware?
Okay, so you have to check Delaware's Secretary of State. You can do it by just Googling Delaware Secretary of State. See if the name is available on the website. If the name is available, you can use the same name. You cannot maintain the same EIN if you decide to register as a C Corp in Delaware. So it's easy to check the Delaware Secretary of State. It's free, just to see if the name is available. If hypothetically you actually are doing business in Massachusetts or Nevada, and you have the name as a Massachusetts or Nevada LLC, it doesn't necessarily mean that you can qualify to do business in that jurisdiction as a C Corp. In other words, there's two parallel tracks that occur. Track one is names for LLCs. Track two is names for C Corps, and they don't always mix. But you can certainly check the Secretary of State's website in both the jurisdiction that you want to do business in, hypothetically Massachusetts, as well as Delaware, to see if it's available. Okay.
Okay. I'm going to have Bill ask his question because the next question that's in the chat also applies to convertible notes. So we'll just wait on that one. Go ahead, Bill.
Well, I think the question I was going to ask was about the, because I asked several in here, so I'm not sure which one you were referring to anymore.
You asked between the 10 and 20% option pool, what is expected for seed level versus A round?
Yeah, but when looking at your Excel, your spreadsheet there, you know, as you go farther down the line, and an investor doesn't want to be diluted, so he wants his X percentage, right? So you got to increase the pool in order to meet it. So the question is where to start. Do you start at the lower end of 10%? Do you shoot for the middle, or do you shoot for 20 and say, investors, suck it up?
It's a great question. What I'm representing, look, first off, this is market-based analysis, okay? This is truly every piece of equity that comes out of the company on day one dilutes the entrepreneurs and not the first investors, okay? That's really, really important for the entrepreneurs to understand on this call. Let me repeat that. When I increase the option pool to 20%, that's always, quote, pre-money. And that means the entrepreneurs suffer dilution, not the investors. So hypothetically, if I'm able to get an option pool at 10%, that's half the dilution I would be suffering as an entrepreneur on that first round versus the 20%. Okay. So that's point one. Point two is it's a market-based discussion. If we were having this conversation 10 years ago, I had never seen 10 years ago a investor who would accept a 10% post-money option pool. Okay, We are living, though, in a frothy environment right now, particularly in Silicon Valley. A frothy investment environment means entrepreneurs are getting better deals than they did previously. And therefore, I actually haven't seen too many entrepreneurs who have been required to take a 20% post-money option pool. It's usually closer to 10% now. That's the market that I'm seeing. Okay.
Okay.
3, the option pool reserve is designed to last 18 to 24 months. Or in other ways of saying this is until your next round of financing. So if you can get the grants and you've got a hiring plan that matches through the until the next round of financing that can keep you at 10%. And by the way, you may not be able to, because you've got to go make some great hires, CEOs, 5 to 7% of the company right off the top, right? So the hiring plan is directly designed to match the hiring plan is designed to match what the option pool reserve looks like. Okay. Having said that, you can bet your Series A investor is going to want a similar size pool at the next round. So I would have enough shares, but not too many shares in the reserve to get your next Series A investor and have this conversation with your Series A investor if we did a seed round, that we have to, quote, refresh the option pool. Because at that time, the first investor and the entrepreneur are going to be on the same side of the table. They're both going to be diluted proportionately by increasing the option pool once the Series A investor makes another check.
So it sounds like it's better to start at the low end and then you work with your seed and A as you go up through the chain as to what they want, up to the max that you're willing to put out.
But don't come up with like 0 or 3%, because we need a market-based analysis here, because you want to look legitimate and that you don't want to negotiate too hard for something that's just not going to happen, because you may lose a different deal point. So there's this market-based analysis I like, but I like starting at 10%. And these days I'm actually winning the arguments. Like, look, there's a lot of money in the marketplace. This is what we're seeing repeatedly. The farther, as Judy noted, I often practice in Santa Barbara. The farther we are from Silicon Valley, the harder it becomes to have, quote, a market-based analysis. And I am very conscious that it's better to get money in the door than to fight about some of the corner case scenario. I tell my entrepreneurs, if you've got one investor and they're really excited by this deal and you got nobody else in the door and they want like 20% dilute, hypothetically aggressive terms, and there's nobody else around, I'd rather take the money and live to fight another day than stand on principle. Okay. Having said that, when you're talking about investment opportunities, it's a horse race. If you can get a market-based deal from an investor you like and trust, or even if it's a little bit more dilution to you, but you like that person more than another person, this goes back to my first slide. This is a partnership without an angel investor. This is a partnership for the lifetime of your company. Find the right fit for you. And that dilution long-term, if you're creating $1 billion market, it's probably, worth thinking about, not fighting about the nuances too much.
Great, thanks.
Okay, so the question that's still here that applies to convertible notes as well as other types of investment, what are the pros and cons of taking a smaller sum of money versus a larger sum if you don't necessarily need the larger sum?
So I love that question because it's so complicated. It's hard to unpack that in one sense or less. Okay. On one hand, you don't want to suffer dilution. Okay. Take the money you need, not the money that's being thrown at you. On the other hand, when you really do need it, it may not be there. Okay. So we're living in a frothy environment. But if you'd asked me 12 months ago, when is the party going to end? I would have told you in 3 months from then. Meaning that frothy environment was going to turn in. This was even before COVID. I was telling people this: prepare for a new marketplace. Okay. Some of my clients have gone out of business in COVID. Some have actually done very, very well. So I'm always of the opinion of, if the money is there and you can stomach the dilution, take a little bit more. I think it's a better, you'll never know when you're going to get to that, when the party is going to end or when the carousel is going to stop and you're going to need that extra cash. Okay. But do it knowing that it just means a little more dilution up front. Okay. The other thought is, and again, this is not to, this is why this is a difficult question, is that, are there other ways to finance your business? If you raise equity, could you go get a venture debt line of, can you go get a bank line of credit to support the business? That's not as dilutive. Are there other players in the marketplace who are willing to support the business as you grow? Personally, going back to the fundamental question, I kind of like taking more money than less, because most of my I always like taking more money than less, because my entrepreneurs always underestimate the length and challenge and pain to raise the next money. Take a little more because it's going to take you longer to raise the next round. Okay.
That's good advice. Now, convertible notes, if you want to tackle that for
sure.
a bit.
Sure.
Even though Judy said that we were, planning for an hour for you, all of our notices tell the entrepreneurs that the class goes from 5:30 to 8:30, so you can take more time.
Well, I apologize for those who are hoping to have dinner, and at the same time, just bear with me a little longer here, if that's okay with you. I'm not going to go into too much detail about convertible notes, but I am happy to spend as much time as this group wants to kind of answering, fundraising generally and then convertible notes. One thing I'd like to say about convertible notes as we get started is, I said this up front, and the process to raise capital is a long-term process. Okay, it's a constant challenge that people have, because you're always going to run out of money. And you may pitch, and you may have due diligence, you may have different investors, you may have term sheets you like, may not, but it takes, you need to plan for the timing, okay? And convertible notes offer two benefits. One, it's offered as a bridge between financings. It's also it's a useful tool for early stage investors who want to postpone that hard negotiation about a priced round today and all the incumbent rights that I went through in that summary that I already provided. But there is interest attached to it, okay? And while it's cheaper to do, it's not free money, okay? Because there are questions about valuations. We're going to get to it. But let me take a step back and say a couple things. First off, there are three effective types of equity which investors can sell you, the entrepreneur. Or better yet, let me say this: there are three types of instruments that you can use as an entrepreneur to sell equity in your company. You can you can sell equity directly. You can offer common stock, like you would do the entrepreneurs. You can offer preferred stock, what I was talking about earlier. You can offer debt. You can just do a bank line of credit. If you go get a bank to support your business, that is a model that works. People actually do get bank lines of credit. It's a receivable line. Not all that typical for early stage companies, but as your company grows, that is a meaningful way to raise money. It's just straight up debt. There's convertible promissory notes, which I'm about to talk about. So there's equity, there's debt, and then there's something called derivatives. Derivatives, these parlance is it's equity-like, but it's not equity, and it's not debt-like. It's something that I see a lot these days called SAFEs, Simple Agreements for Future Equity. I'm just going to mention it because I want to put it out there. I also want to put out there that I will address later the differences between convertible notes and SAFEs, but as I'm saying as a preliminary matter, there are three fundamental different types of instruments: equity, debt, and derivatives. Okay. Convertible notes are, as a core, they are they're debt. It's a term loan with interest that is repaid in cash or it's repaid in equity. The intent of a convertible note is to have a loan that effectively converts into the next price round of your company rather than being repaid in cash. So because it has the right, but not the obligation, it has the right to convert into equity in the future. It's a security. And for all intents and purposes, a security is governed by federal and state law. It's not a simple instrument that you can just go and say, it's easy to do, I have it. I want you to understand that there are securities laws that exist for equity, and it also exists for convertible notes, okay? So why do people actually like convertible debt? Well, they like it because it's simpler, it's faster, it's cheaper than equity. It's a hell, pardon my expression, but it's a hell of a lot easier and easier than negotiating a preferred stock financing with 90 pages. So as a result, it's a little bit cheaper to do, okay? As I said already, there's a slight bridge on valuation. We're not actually negotiating hard on valuation as you would otherwise do with a priced round because we're not selling the instrument today. Okay. What are the key terms that we think about? Well, I'm going to give you those key terms. I'm just going to verbally communicate them to you. Hopefully you're taking notes. Okay. Key term one, the principal. The principal of the loan is the original loan amount. It's the amount that people are giving the company. There's the interest rate. What's the rate for money on money? What's the term of the note? When is it actually due? When you have to repay it? Is there a way to prepay it? There's a prepayment mechanics. Could it be prepaid prior to maturity? Security interests are funny. Security interests, does the lender, the person who lent you money, have the right to grab your assets if you fail to repay the loan? Typically, loans are unsecured. Like bank loans are secured against your assets. But sometimes, particularly real estate investors, ask for secured interest because they're used to security interests on real estate deals. Okay. Default. Let's say you can't repay the loan or something else happens. What actually happens? Now what? So, and then finally, for this particular note, there are amendment provisions. Those amendment provisions are probably, even though people don't think about them because they're like the back of the agreement, those are probably the most important terms that we're ever going to talk about. I realize, and David Crane's reminding me there's valuation caps as well, which it's not just valuation caps, but I completely agree. It's also conversion ratios. How do those notes convert, which is important, and I appreciate it. Thank you for the reminder. Okay. The amendment provisions basically say, despite everything else in this document, we, a majority of your note holders typically, have the right to amend any term of this note, so long as we all agree. We, majority of the note holders, agree. And that's really important. If you go out and raise from 10 or 15 people, you go get 6 or maybe 2 of them who put the majority of the money in to agree to amend the terms. So the amendment provisions are really important. The interest rates that I typically see for early stage investments, market rates, are something where between 5 and 10%. Okay? The method of calculating interest is twofold. You can either have compound interest or simple interest. In my experience, simple interest is the more common way. It's just easier to calculate. And the benefit of interest rates is it gives the investor a little bit of a kicker in the deal, but the juice on the note is not the interest rate. The juice on the note is the convertible features, which we're going to talk about in a moment. Okay, so the market rate might be 5 or 10%, which is clearly better than what you can get from a bank right now, but it's not a whole lot of interest. It's not a huge deal. Okay, so I like to say, market rate 5 to 10%, simple interest, just compound, just count days for simple interest purposes. Okay, and the juice on this is the conversion features. Why should I, investor, give you startup money today? why don't you just call me when you're ready for the price round and tell me the deal is. Well, you, the entrepreneur, are going to say to me, I actually want your money now, and I'm willing to give you a benefit versus the price round later. That benefit is not the interest rate alone. The benefit is the conversion features. What the shares will convert into in that priced round, and what's the discount on that next round. The discount I see is somewhere between 10 and 30%, and I usually arrive at a 20% discount. Okay, it's designed to incentivize the investors to participate in the round, and it's a discount as compared to subsequent equity investors. Okay, now somebody thought this was a really great idea 15 years ago, and then 10 years ago, somebody did these notes, and they invested in Airbnb. And Airbnb, when they invested in it, had a valuation of $5 million. And within 18 months, the valuation of Airbnb went to $100 million. And the angel investors who did the convertible note were shaking their heads. They're going, well, wait a second. I'm only getting a 20% discount on that $100 million valuation, even though that incremental growth was designed by my cash. You were able to stimulate the company by my $3 million convertible note offering to build the company from a $5 million valuation to a $100 million valuation, and I'm not getting the benefit. And I've got to pay the premium. I got to pay like 20% off $100 million. That doesn't make any sense. So people thought, hey, let's have this something called a valuation cap. Okay, the valuation cap is the highest valuation the company at which the notes will convert. In other words of saying this, it means the investors will own no less than X percentage of the company upon conversion of the notes. So going back to the basis of the valuation cap. If you're an Airbnb investor and you did a convertible note and the value at the Airbnb was $5 million and the company then becomes a $100 million valuation, you have a valuation cap that says hypothetically, look, the valuation cap in the note's $20 million. So all that incremental value I'm going to benefit from. I'm helping build the company, I'm increasing the value, and I'm going to benefit from that. Okay. So if I was an Airbnb investor in that bridge deal and I didn't know the value was going to go to $100 million, I'd say the valuation cap is $20 million, and that $80 million of incremental value is all benefit to me. I'm benefiting from that, and I'm benefiting from that when the notes ultimately convert in the future. Okay. Now, let's go back to the Airbnb model. If I put a valuation cap in there at $20 million, but the next round investor, the price round comes in at $10 million, even though I had a valuation cap of $20 million, what happens to my note? Well, in the Airbnb example, if the valuation cap is higher than the next priced round, the investor wins too. The investor gets a discount off the next valuation cap. They get the greater of the discount. If the valuation hypothetically was $10 million for Airbnb and the valuation cap was $20 million and the note had a 20% discount, the notes would convert at $8 million because the valuation, the next round was $10 million and I got a 20% discount, or the notes would convert at $20 million because if the value went through the roof, they would be capped. Okay. So again, the valuation cap is typically designed to put a ceiling on the valuation or a floor on the minimum percentage ownership the investor owns. Okay. One thing that has actually happened over time as people have gotten more sophisticated with notes and valuation caps is how do you establish the valuation cap? There's different theories here, let me be quite frank. Okay. One theory is the valuation cap should be today's value, period. The other theory is it should bear some relation to an estimated current valuation at the time of conversion, right? So what the value of the company would be in 18 months, not the value today. As you can see, this is very different, value today versus the value in 18 months, okay? When I'm talking to entrepreneurs, I'm identifying this and I'm explaining the greater the valuation cap, the better you are as an entrepreneur, okay? Because it's obviously you're going to have less dilution once that note converts, okay? And the other argument that I typically have with investors is that if it was a valuation, it wouldn't be called a valuation cap. You don't get the greater of the discount or today's value. It's the not today. That's usually that is usually my argument, and I don't always win. I'll be quite frank. I don't always win. I try to, and I want the entrepreneur to understand the nuance. And the point being is you try to have a valuation, and again, going back to the valuation cap, that's reasonably related to what the value would be in the future at some point. Let's see.
So Josh, Chip asks a very specific question about a convertible note including a high interest rate combined with a regularly paid monthly interest payment. He wants to know if he can renegotiate that. He can try.
Yeah, most of my startups can't afford to pay the interest period. Okay, and so the benefit to the investor is to have that interest rate be relatively low, but benefit by getting more equity when the notes convert. Okay, a high interest rate means you got to pay a lot more money ultimately negotiating interest payments, which you may not have cash for. If you don't have cash for it, may be in default. What happens in default? So there's a series of bad consequences that could occur if you actually have to make monthly payments. On the other hand, if you're cash flow, if you're cash positive and you're able to make those monthly payments and you're not going to be as diluted, then maybe you're willing to trade it because you don't want to actually suffer dilution to accumulate the interest. And you have a low conversion threshold that's included. In other words, the discount on the next round is low enough that you're happy to pay a little bit more interest. It sounds to me, Chip, like it's more like a factoring deal. And in some sense, your investor is getting the benefit of a high interest rate. So making money on their money at the same time benefiting also from a conversion feature as well. So, but again, this is all negotiable and every deal is a little different. And I encourage you to try to think about your particular situation. Okay.
Bill has a comment.
Yeah, if I could, just real quick, I just wanted to, your comment about the pre-money, not pre-money, the valuation cap. I think you have to be careful about getting too caught up in a valuation cap at the pre-seed level, largely because at the pre-seed level, you're either at the very beginning stages, of a product, no revenue. I mean, you're just getting off the ground. And further down the line, I would say at a seed level, A level, you're now into valuation discussions where that becomes important. The valuation at the pre-seed level, frankly, is not a science, it's a guess at best. Somebody says my company's worth $1 million and I have no revenue and I barely have a product. Good luck convincing most investors.
Yeah, I agree with you entirely, Bill. That goes back to the point of, in some sense, it's a market-based analysis here. And if you've got a certain group of people who are excited about your business and you're not really thrilled about the valuation, but you like that particular person, I think it's important to understand that investor is, that first investor is probably the most important for you. It'll propel the company's growth over time. And that person, I often use the example, I stick my finger possible. Can you live with, particularly if you're pre-seed, because you're going to probably pivot 3 or 4 times. Who knows, right? But you have to understand at the same time as the entrepreneur that part of your pitch to the investor is explaining what they're investing in. Okay, and that the value. I basically I agree with you entirely, but I also want the entrepreneur to understand that part of your pitch is to increase part of the pitch is to get the highest valuation possible that's reasonable for your business, right? And it's not just about the valuation. It's about why that investor should invest in you. You know, at the end of the day, it's a business conversation. You know, can I get $500,000 or $100,000 or $50,000 from my first check investor? Yes, I can. That's great, and that will help propel the next conversation as well. So I agree with you completely.
Yeah, I think from the other side of the coin, the investor at that level doesn't pursue pro rata rights. They're not going to pursue, they're going to get diluted. And that's why they tend to go for lower value caps, because it gives them bigger bang for the buck when they first start out at the pre-seed level. Beyond that, you know, that you're into all kinds of different discussions.
So that's right, except there's no reason why the angel investor can't ask for pro rata rights, right? So there, if
they typically don't, but or they
do.
They
typically don't.
They don't exercise it. A lot of them.
That's right. That's right. The one thing that I mentioned up front is I'm seeing a lot of safes these days. Okay, these are simple agreements for future equity. This is a Silicon Valley Y Combinator model that's come up a lot recently, and it's kind of pervaded the Los Angeles marketplace as well. So convertible notes are, particularly pre-seed, convertible notes are fantastic. Okay, they're really helpful, and at the same time, I'm seeing a lot of people issue safes. And the reason I bring up the safes example here is only because the VCs are writing checks on safes as well, and what they're doing is they're writing side letters. They're asking for those rights we're talking about, not in the safe document itself, because everybody else sees them. They're asking for them in side agreements that are asking for the pro rata rights. And there's no reason why an angel investor, particularly a syndicate, couldn't actually get those same rights. And they frankly should ask for those same rights. That's just a conversation that they have on a go-forward basis. Either way, I'm not to. For the entrepreneurs in the room that are listening to this presentation, what we're saying is getting the right investors in the deal is important, and getting the first investors in the deal is important. And you know, the valuation conversation, it is important, but a broader conversation is if you've got, you know, if you got one investor want to give you a $100 million valuation, but your company's not going anywhere, it's worthless to everybody. You're creating a business where you want the right people around the table to create the right business, because everybody's going to win in the long term. Okay, and you want the right people around the table. So the dilution conversation is important, just so you know, but at the same time, having the right people helping to get you to the next level is just as important, and I think probably more important than that as well. Okay. The other interesting thing I'd like to say on convertible notes, we talked about conversions, we talked about discounts, we talked about maturity. The other thing I just want to mention on these convertible notes, and maybe kind of wrap it up and have you guys ask questions of me if we haven't already answered, is what happens if we have a liquidity event prior to maturity of the notes? Okay, like it's not impossible that your startup is really interesting to fill in the blank company, Amazon, Dropbox, Google, blah, 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 and they want you as a team. Okay, and we never do a priced round. Okay, if that scenario occurs, what I see occur is something called a premium. Okay, it gives, if the company sells prior to maturity date, the company pays the note holders a cash payment based upon principal plus interest plus some multiplier, about 1.5 to 2 times the principal. Okay, it's used as a mechanism for the entrepreneur to get the angel investor in the deal. Okay, and not have to worry about that angel investor converting into equity immediately prior to the sale. It gives the investor comfort that they're going to see a return on their investment, and a real return, not the 5% we're talking about on interest. And you're not going to worry about the valuation conversation with your entrepreneur, with your investor. You're just going to get a return, a real premium on the return. And then the last point on that note is, well, what's the other situation which occurs is what actually happens at maturity and you never do equity financing. You know, what actually happens at maturity if you never do an equity financing? Technically, your notes would probably be in default. Okay, so the note holders may ask to be repaid. It is a loan after all, right? It's the money to be paid. You could typically, what I see is if the notes are in default, you apply an increased rate of interest, a default rate of interest, maybe another 2 or 3%. Okay, and or the note holders may declare the notes due and payable. They have to get paid back. If there's any money in the company, they get paid back what's ever left. Usually there's not much left. Instead, what they do is they just leave the notes outstanding. You pay a little bit more in interest, and they wait to have those notes convert into the next priced round. Okay? They wait to get the benefit of the next round value, if there is anything, plus they get a bit more of interest. Okay? Meaning, if there's a default, the note holders have the option, but not the requirement, to convert into securities at some valuation, but they also get the right to just leave the notes outstanding and get a bit more interest on it. Okay, so that's really what I had to say on notes. I can go on and answer any questions you guys have, and we can get creative and all that stuff, but we are obviously spent a lot more time than we initially anticipated. I'm happy to answer questions, and just I'm here to be be thoughtful for you if you have questions at this time.
So Ryan has a question. He says, would it be a better route if you could self-fund and use revenue to reinvest until you become cash positive and essentially skip your seed round to a Series A?
So a company who did that is a company called Product Plan. If you Google them, you'll see that the founder of that company wrote all about it. That's the corner case. Most companies can't get there. Most companies can't get to cash flow positive without an infusion of cash. That question I mentioned on day up front on the business diligence is your business scalable? Is it going to grow exponentially? And if it's going to grow exponentially, it typically takes an infusion of cash. And that cash comes from the angel investors and comes from the VCs. So usually it's the infusion of cash to grow your company. And even if you wait till the Series A round, it could take you years to get there, to get to cash flow positive. And even when you get to cash flow positive, by the way, you're still in the same conversation. You're just in a better position, right? You may not need the money, but all the conversation we're having here is just if the valuation is higher than it is on day one.
Okay, I don't see any other questions. Judy?
Well, I'll fill in for a couple of announcements in case anybody's working up the courage to ask a question. So there were a couple of questions about, hey, how can I get engaged with Carta? Who are some legal people that we recommend? So I'll state again, we have a whole community here at Startup NV of attorneys, and we have a relationship with Carta so that the people who are affiliated with Startup NV get a discount on their services. Like Josh said at the beginning, it's an awesome product. In a company, it takes a lot of the complexity out of managing your cap table and figuring out, what if scenarios, if I do this, if I have a valuation of that, if I have an option pool of this versus that percentage, it helps you work through all those things as a founder. And there's a free tier until you've actually raised $1 million. You can actually get it free, and then it starts to cost you at that point. And if you're affiliated with us, you get a discount when you do actually have to pay. So I'll say that. And we also have a bunch of awesome attorneys, various kinds of attorneys, people that do transactions, people that help you with patent law, people that help you form companies, all of those things. They're all, almost all of them are available through our VOID program for those who aren't in the incubator. For those who aren't in the accelerator program, and for those who are in the accelerator program, there's just straight up referrals. Just ask your coach or your mentor, and we'll connect you with the right person. So there's those aspects, and I'll take some of these examples that we used tonight and put a really concrete example together for this group. FundNV, the company or the fund that we operate for our accelerator companies, has very specific terms. When the people come into the accelerator, they know that we're writing convertible notes. They're $50,000 investments. They're 8% 2-year notes over at 8% interest, a 20% discount, and $1 million valuation cap. We will trade, some valuation cap for a higher discount, depending on where the company's at. But almost everybody is at that point where they have no revenue. They're about to convert into revenue. Maybe they have a little bit of revenue. And trying to figure out what a valuation is just fantasy. I mean, it's impossible. And I'll mention one other feature that we have in the note that you may go, huh, when you hear about it, Josh. And we have something we call an anti-zombie clause. From hearing all of my angel friends who have had 40, 50 investments, and maybe they're up into their 70s or 80s, and they have a bunch of these investments that never converted. So because they've changed into lifestyle businesses. And so the idea is, hey, we're going to convert this note to a revenue-based note. We're going to take 5% of your revenue until we're paid back 2x on the note. So it's very similar to what you said about getting a premium, but it actually spells out the scenario if it does turn into a situation where there's just no more investment or the note never converts. Still, it's a hardship if there's just no conversion because the company's not doing well. But we try to anticipate that kind of stuff for, sort of rational situations. And we tell our investors that you should invest in FundNV because we're going to pick great companies. We're going to have a good cap on evaluation for these really early, riskier companies. So if we do pick an Airbnb or another unicorn kind of situation, it's going to take a few rounds to get there. So you're not going to benefit from the full spectrum of the thing, but you'll at least benefit from that next round of probably getting a little bit of an outsized percentage of the company than you might otherwise get. So this is stuff that works in the real world. We're a living, breathing example of it with Startup NV and Fund NV and our program with AngelNV, where we're teaching the angels how to think through these things as well. So those are some real world examples. I don't know if any other questions came up while I was rambling on there, but those are some real questions. Maggie, did anybody else come up with any questions?
No, they haven't, but some people have thanked you, Josh, for a great presentation.
Yeah. And I thank you, Josh, as well. Thanks, Judy, for introducing Josh, even though apparently we lived near each other for about 10 years and we didn't know it. So awesome presentation. I think Josh is going to make the deck available to us, and we'll send it along to the people who were here tonight. We also have this recorded, so we'll do a little bit of light editing to it and then put it up on our YouTube channel. So you can consume it that way. It'll take me a few days to get the editing done, probably through the weekend. So look for some kind of notice on on Monday. And if you do subscribe to our YouTube channel, every time we put a new video up, you'll get a notice that it's there. So I would suggest just jump on the YouTube channel and subscribe, and you'll get a notice whenever this video and any other videos that we put up are there as well. So I'll pass it back to Judy to see if she has anything to wrap up with, and Josh to see if he has anything to wrap up with.
Yeah, I'm glad everyone enjoyed Josh's presentation. Thank you, Josh. No, nothing to add. Thank you so much. Thanks, Josh.
Thank you very much for having me. It's an honor to be here.
Thanks so much, Josh, and thanks everybody for coming out tonight and spending more than the 60 to 90 minutes that I said we would spend. But I mean, I can listen to this stuff all night. I mean, this is what we live and breathe. So it's super geeky and fascinating. So thanks, and we will see you all next week at the same time, and we will be dealing with the application process for AngelNV. So thanks again for everybody for coming out. Have a great night, and we'll see you next week.